Ladies and gentlemen, it's a great pleasure seeing you here for the Q1 advisory board featuring my dear colleague Mark Walek.
Hello.
And our very, very special guest, Tavi Costa. Tavi, hey.
Thanks for having me, guys. Looking forward to this conversation.
Tavi, the last time I saw you, we were running up that hill at 5:30 in the morning in Beaver Creek. You almost died.
You almost killed me. Let me rephrase this.
That was fun. It was a good conference as always, and we thought that's probably the worst sentiment that you can imagine in the mining space, but I think it got even worse over the last couple of months.
I made a promise I won't talk about sentiment anymore because every time I do it gets worse. So it's astonishing how I do think that has to be near the bottom in terms of skepticism in the industry, because I've never seen just such an unloved industry overall. It's shocking to see that.
We will talk about that today at length. As Mark and we always say, the market is a pain maximizer. I'm not sure if we have already seen maximum pain, but we've definitely seen a lot of pain already. So we should be pretty close to the bottoms. But ladies and gentlemen, let me briefly introduce our special guest, Tavi Costa. He is here actually for the second time. He's a superstar on Twitter with, I think, more than 250,000 followers, putting out brilliant charts. We know each other for quite a while. As you know, Tavi is a member and macro strategist at Crescat Capital, and he has been with the firm since 2013. He's responsible for developing Crescat's macro models as part of the thematic investment process. He's quite frequently, on TV, Bloomberg TV. He's in the Wall Street Journal, on Reuters, on Yahoo Finance, whatever. And as we all know, the whole industry just loves Tavi's charts. So Tavi, thanks again for taking the time. We really look forward to this one. Just some housekeeping to get started. What's going on our end? We published a couple of new chart books. As you know, we've got a quarterly Bitcoin compass now, and we've got our monthly gold compass, where we show the most interesting charts from Bitcoin, gold, miners, macro space, and so on. You can download them totally free of charge on our webpage. Then we're also working very, very hard on the upcoming In Gold We Trust report. May 17th is the big date. Now we're kind of in the process between procrastination and panic. So we're getting into the hot phase, the crunch time of this year's In Gold We Trust report. And it will be lots of work, and I think we'll all be pretty relieved when we can hit the send button on 17th of May. But as you know, we truly enjoy crunching the numbers, researching, thinking, and writing about gold. So it's also something that we pretty much enjoy. And then last week we launched a new fund, an active gold strategy. That was right the week when actually a hotter CPI print came out, and treasury yields were up significantly, gold was down significantly, the miners were sold off. So it was quite a contrarian move, I would say. But the good thing is that actually Stan Druckenmiller, he also, it was announced that in the fourth quarter of last year, he actually bought quite significant stakes in Barrick Gold, I think 1.7 million shares and 500,000 shares in Newmont Mining. Still, compared to the rest of his portfolio, it's not very significant, but he's also been reducing, for example, Nvidia by roughly 30%. And it seems that he's continuing to buy in the first quarter of this year. So yeah, quite a lot going on with the new fund. Lots of work, lots of marketing. We're really proud about this strategy that we can talk about a little bit later on. But let's jump into the discussion. Tavi, I think it was really interesting what you put out a while ago, which was really a very brief and concise summary of what's going on. You said we've got a trifecta of macro imbalances. We've got a debt problem reminiscent of the 1940s after the Second World War. We've got a speculative environment like the last time we've seen it in the 1920s and 1990s. And we've got inflationary concerns similar to the 1970s. You wrote that actually quite a while ago, but it is still super relevant. So what's your take on that? And if you could give us like a brief overview of all those three topics.
Well, I think that's an important constraint for policy making in general, and then what creates the bullishness and the likelihood of commodities and hard assets to do very well. And looking at the positioning of investors in terms of not only the traditional portfolios, but also large capital allocators such as central banks, it is not in line with those constraints, meaning it's highly likely that because we have a problem of the debt in which causes the more monetary dilution over time becomes almost inevitable. At the same time, I think the genie is out of the bottle when it comes to inflation. Certainly, we're seeing the consumer and businesses being impacted by inflation in different ways, regardless if it is through shelter costs or auto cost or health insurance and so forth. And all that is very ingrained and deeply ingrained in the economy. And it's changing the way consumers behave. It's causing consumers as well to ask for higher wages and salaries. So we're now unleashing a labor cost trend that tends to be very secular at its nature. And then on top of it all, we have this valuation problem that you referred to that is very similar to what we saw, especially in the tech bubble environment. And it can be measured in different ways. I think one of the the cyclically adjusted PE ratio is probably one of the most interesting ways to measure that level of frothiness in equity markets. And I think that there are some great opportunities, but places that I would completely avoid, which is the U.S. equity markets today look very frothy overall. And I think that the outcome out of these trifecta of macro imbalances will be that commodities will outperform, especially financial assets, long duration assets like treasuries and especially the technology space. And emerging markets could do very well on the back of those trends as well. And so there's going to be lots of opportunities and some big changes in capital flows and market leadership. And so, which I have very strong views on how to express that in the markets as well. But it's definitely a big change in the scenario that we've had over the last 2 to 3 decades, what we're facing now.
May I jump in here? So I would like to dissect this a little bit, perhaps going into the topic of debt. So we've been writing a lot about debt, and then it's a little bit the elephant in the room, I think. What are the indicators that you are looking at which tell you it's not sustainable? Or I mean, we all know it's not sustainable, but that now actually perhaps the market views it differently than recently or perhaps a few years ago. Are we there already, or what are you looking? What would have to happen that you say, okay, now there's really a change in view on the debt situation?
Well, the debt situation, I think, has been the big change in asset correlations that we're seeing, that I think has started after the COVID recession and the stimulus that came out of that contraction in the economy, and what caused some big changes in how markets have been behaving. So to me, we're already in this new era, in an era where you're seeing interest rates behaving differently relative to equity markets. I think that that's going to be a big question for 60-40 portfolios, traditional portfolios that used to use different ways of hedging their portfolio construction. And so we're certainly seeing that already. Cost of capital staying higher for longer. But to answer your question more specifically about government debt, I think the biggest thing that called my attention a few years ago and that I've been focused quite a lot has been the issuance of debt. And the issuance of debt it's been an amount that we haven't seen in the past. We've seen maybe during periods like World War II, if you adjust for inflation, if you adjust for levels of GDP and so forth. But certainly what we're seeing in terms of this large amount of issuances creates a downward pressure in treasuries overall. And it puts I think an interesting environment as well when it comes to the cost of capital. Cost of capital, I know a lot of people use that phrase now, staying higher for longer, is yet to impact markets, and we haven't seen much of that, even from a market concentration aspect. If you think about how market concentration usually happens, it tends to happen during low treasury yields, and now we're probably yet to see this concentration dissipate, and especially given probably the weakness of mega caps moving forward relative to the overall market is one of the things. But the issue with deglobalization also is a huge factor that is adding to the treasury weakness over time, in my view. Certainly what we've seen so far with central banks buying more and more gold is reducing the demand for treasuries at the end of the day. And we can say that they're not yet big sellers of treasuries. If you looked at on a net basis across the globe and across all central banks outside of the Fed, we're still seeing that those central banks are still buying treasuries, believe it or not. But they're not buying it relative to the amount of issuances, which is the big point here. And so issuances are increasing. We're not seeing the central banks, foreign central banks, step up their games here. And so, ultimately, how does that all resolve? Well, the central banks in the U.S., especially the Fed, has to be picking up that bill and probably will. It's one thing I noticed that I'm not sure other people have noticed this recently, is the monetary base in the U.S. is rising again at levels like we haven't seen since the QE1, QE2, and QE3 environments and the COVID stimulus. So we're starting to see that pickup in monetary base one more time, which to me is it's highly inflationary. A lot of people don't see that link, but I think you guys certainly do. And monetary dilution is a problem, and it's not being caused by the increase of money circulation, but it really is by the banking reserves. And so, because monetary base is actually broken down to two composites, it's the banking reserves and money in circulation. Money in circulation has been flat, but the reserves have been increasing. And so monetary base is now on the rise again. I think it's up about $400 billion annually. And so, those things really are part of this whole story of where governments will be able to find the demand for to finance their debt, and it ultimately falls back on the Fed.
Okay, thanks for that. And perhaps on the topic of inflation. So I mean, currently, at least according to the official stats, we obviously have seen inflation numbers coming down quite substantially, actually. So I think in the mind of the average Wall Street investor, at least, the inflation problem isn't that imminent anymore. I think if you talk to the people on Main Street, you get probably different reaction and different answers, just to the fact that prices haven't come down, which they also probably won't. But there's still, everything is extremely expensive, so high prices are still a problem. They're just not rising as fast anymore. Nevertheless, if one takes like traditional inflation numbers, so I guess you do expect these to go up sooner than later. Am I correct?
I'm of the view that reacceleration of inflation is likely to happen, and just because of the studies that we've done on waves of inflation in the 70s and the 1940s, and then even in the 1910s. And it's really interesting how in the US and other developed economies and even emerging markets, you tend to see inflation developing through waves. We've had this deceleration you pointed out, but still, look at nominal PCE is still at 5.9%. So if we're bottoming at 5.9%, I don't know, hold my beer, but that's not good at all. I think one of the factors that I've been really focused on recently that I would emphasize here is that surge in immigration in the US. If you looked at academic papers about illegal immigration and the surge of that in any country, there's really three buckets that you can think about what causes growth in an economy, essentially. It's technological advancements, number one. Number two would be this issue with population growth, not issue, but population growth would be the second one. And the third one is finding a great amount of natural resources. Abundance of resources certainly causes an economy to grow. In the US, I think what we're seeing in terms of this growth of population, mostly, almost entirely driven by illegal immigration, it's actually going to have an inflationary impact, especially coming from shelter cost. Shelter cost is probably going to continue to move higher. We're probably entering an inflationary decade in that front. And it's hard to believe that if we are indeed in entering that long-term trend, that's not going to be also highly inflationary to the consumer. I mean, if you think about what impacts consumers the most, it's definitely his shelter cost. And so I'm quite afraid of that. And we're seeing signs all over the markets. If you look at break-evens, is starting to rise, especially on the short end of break-evens, which is the expectation for a CPI is going to be in different durations. And you can see that it's starting to rise relative to the CPI number, for instance. What's happening with the deglobalized environment in terms of the Red Sea conflicts and other conflicts worldwide definitely add to that pressure as well. And in fact, the container cost that we're seeing in terms of the freight costs globally increasing, it's something that is going to add to that inflation trend as well. Food prices is another thing I've been pointing out recently, which has to do with agricultural commodities starting to rise, and it's been diverging from overall food prices. I find it impossible almost to think that that won't have an impact on the price of food overall in the world. And so all those things are likely to play a role into create a bottom for inflation over time. And so I've been what I said about monetary base and other policies. We're all focused on QT, myself as well, QT and the rate policy. But look that there's all these other policies happening under the hood that are essentially offsetting all these two very restrictive monetary policies that we're seeing from the Fed. In fact, that's some whole reason why we're seeing monetary base increase and other measurements of monetary dilution happening, under the radar. That is, certainly inflationary as well. Not to say anything about the reckless amount of fiscal spending that we're seeing, which certainly adds to that page. The reshoring that is almost not only something that has to happen across most developed economies because of this push towards reducing the reliance of authoritarian regimes and this rise of geopolitical concerns that we're seeing is certainly going to be driving those developments of reindustrialization and revamp of manufacturing capabilities, all going to play a role into the inflation camp too.
So just to finish up the trifecta, if I may, sorry, Ronnie. Given what you said now regarding inflation and coming to the last point of the trifecta, the speculative mania, basically, or exuberance, or however you want to call it, that would be probably, in my view at least, on a complete collision course. If you actually have inflation surprise on the upside, we won't have any, I don't know what your view is, but how the monetary policy will react to that. I think that would be some kind of a big problem for risk assets. I mean, how do you think this will resolve itself then?
Yeah, well, I think the risky assets front is definitely an issue, because you can make the case that during inflationary periods and sort of a banana republic environment could potentially cause equities to go even higher and concentration of markets to be even more severe. I'm not of that view, because I believe that cost of capital ultimately is rising. I mean, it's very important to see that with yields rising, it causes a big change in the whole macro backdrop. I mean, just think about what's happening recently with announcements of dividends across most companies. You start seeing this competition of investors looking for yields. What causes that? Well, that essentially will cause cost of capital to rise, not only on the debt side, which is driven by interest rates, but also the fact that companies are going to have to be paying more dividends. Think about what happened in the 70s, where majority of the returns, about 80% of the returns in the 1970s came from dividends, not the price appreciation. So, that's about to be a reality here. I mean, we're seeing airlines paying dividends now, announcing they're going to be paying dividends. That's crazy. And they're one of the worst margins you can find in the markets today. And if they are paying dividends, it means that this is a trend where most companies are being pressured by shareholders to do the same. Not to mention what's happening in natural resources from an inflation camp as well. That is, perplexing in terms of the skepticism towards those industries overall, but also the overly conservatism that we're seeing there too, which we all know here that, if those companies are not spending capital towards supply in the next 5 to 10, today, we're not going to see any major changes in supply in the next 5 to 10 years. And so that is scary. It's scary, but it's also an opportunity. So, I'm not a doom and gloom guy. I think there's great ways to express your views in the markets and take advantage of all this. And I think the resource space would be one of them.
Thanks, Tavi. I think what's interesting when it comes to central bank policy, you being from Brazil, I think it's, if you compare the central bank, but also the fiscal policy in emerging market countries like Mexico and Brazil to most of the Western world, it was actually, it was much more orthodox. So if we think back to 2021, when central bankers basically were super happy that inflation finally reappeared, and then they kept telling us it's only transitory and temporary. And they were very, very late to start raising rates, as we all know. Meanwhile, the Brazilian central bank, for example, raised interest rates by more than 12 percentage points. So actually, they know what inflation is. They have seen the movie, and I think that's also something that we in the Western world have to start learn. Or perhaps to unlearn many of the portfolio theories that we've learned in business school or CFA, whatever, because everybody here is mainly, thinking through the lens of this whole great moderation, and also as Mark and I we often joke about that. I think that's one of the first sentences in the Schweser study notes for the CFA. It says there's only one riskless asset: U.S. Treasuries. Yeah, but this is clearly changing now. So how would you see, let's say, the industrialized, developed economies versus emerging markets? I know that you're a big fan of emerging markets at these days. Don't you think that they might at some point make the same mistakes again as previously?
Well, let's start with where emerging markets come from, first of all, in terms of their policies, I think. Well, usually their pressure is towards, a trade surplus. It's been always the case where their policies is driven by depreciating their currency to allow exports to increase relative to imports, and being the case that they have a lot of resources in majority of emerging markets. That's always the case. Every 4 years, you got a different president in places that are not authoritarian, like Brazil in this case. And even though you have the shift, the focus from politicians is always the same, is always depreciating the currency. And that creates those long-term cycles in those countries, where the only way to get out of those issues is when commodities begin to pick up in prices. That really causes the improvement of those trade surpluses over time. And so you got to be right about inflation. You got to be right about commodities to be right about emerging markets, in my view. And so where I get really attracted by is the fact that prices are not there. I mean, nobody's betting that we're going to see an inflationary regime when you think about valuations, especially on a relative basis to developed economies. I mean, I put out a chart that maybe you guys can show, which it shows the market cap to GDP, or I should say, market cap to GDP of different markets across the globe. And it clearly shows that South America and some other emerging markets look incredibly cheap relative to U.S. markets, for instance. And you can certainly see that across CAPE ratios and other measurements that also show how cheap those companies look like today. And so in my view, if we do have this long-term cycle in commodities, which I think it's overdue and will probably occur, if that happens, I think that those companies look really cheap. I also think about a little bit of what's happening with AI, because AI, it will play a role into emerging markets in a big way. When we think about the reasons why those emerging markets are so cheap and undervalued, there are some key reasons for that. And one of them, in my opinion, outside of the political environment, which is an obvious one, is the labor market. Labor market, usually the level and the quality of labor markets in emerging markets is much lower than places like the US. And the US is the only true melting pot you can find across the globe, where people from all over the world, including myself, actually came here because I wanted to study in American universities. And there are plenty other folks that did the same and became very successful in their endeavors professionally. And that's what drives competition in the US in a large way. My view is that AI will actually close the gap quite a lot of that quality of labor as we see. Because if you use AI tools in general, it's a big enabler of capabilities. I find it hard to believe that that enabler of capabilities won't have an impact in improving the quality of the labor markets in places like South America, for instance. And as we see that occurring, that should also have an impact on multiples overall. And so to me, it's just I've never seen such a cheap market. I mean, Brazilian markets, just use that as an example in terms of free cash flow yield, is as cheap as it was during the depths of the global financial crisis. And we haven't seen that in a long time, how cheap those markets are. They're paying dividends in a large way. They are growing their businesses. If you look at them historically speaking in their own currencies, we've never seen, for instance, indirect industries from resource space like banks so cheap on the price to book basis and relative to other parts of the world too. And they're incredibly profitable companies. And so all that I think will be an interesting place to deploy capital, given the fact that the commodity markets is so thin that it's likely to, as we see folks really trying to deploy more capital into commodities, they're going to eventually find themselves into emerging markets. But just to make a distinction here, before I finish my point, I think that the time to be a big bear in China and Chinese equities and the Chinese economy was 7 years ago. We were very big, I would say, proponents for the bearish view in China. And I've been shifting that view slowly but surely, just seeing what's happening, especially, we've seen all those defaults and the debt crisis unfolding in China. Now we're seeing the other side of that. I mean, the PBOC just increased their balance sheet by over $850 billion since September, or I should say August. And so those are big changes. I mean, that $850 billion of basically liquidity entering the market. I mean, The Economist just put out a cover basically with Xi Jinping holding a chart of the equity markets and who has control over the markets. And then it shows the line moving further lower and basically proposing the idea that Xi Jinping has no control over that. And look, I've been following the Chinese market for a while, and I would think that those stimulative policies will have a large impact. And it's shocking to see that we've had such an implosion of the Chinese markets, and commodity markets have held up so well. And imagine now that coming on the front of more liquidity driven by them, what would that cause to the inflation case and also to the commodity space and other things? And so, I'm not a buyer of Chinese equities necessarily. And the main reason for that is more of moral issues personally than anything else. But I wouldn't bet against it. I think that is a view to be to have held in 5 to 7 years ago. And now it's time to be looking at what's going to come out of all this, in terms of the stimulative policies that will probably be the case on the fiscal and the monetary side as well.
I agree, Tavi. I funnily enough, I had a close look at the charts of Alibaba and Baidu this morning and compared them valuation-wise to their competitors in the US, and I think the chart it seems like a bottom building, and valuation-wise, they're they're cheap. I mean, I think for Alibaba, they trade at 50% of their of their net cash. So yeah, I would agree, and this is also probably there was a very similar thinking that would be definitely a strong case for commodities, and it is the year of the dragon, and in the Chinese zodiac, the dragon is the symbol of it's the most vital and the most powerful animal, and it symbolizes dominance and ambition and strength, and it might sound strange for us, but it is really important for Chinese leaders. So therefore, yeah, I agree. I think that the China will probably surprise on the upside at the moment, while probably the sentiment cannot get any worse, and this will probably be a trigger for the price of gold, or for commodities, but also for the price of gold going forward. But let's talk about gold now. I think that many people have been somewhat disappointed with the performance. We've seen a new all-time high in US dollar terms last year, and we went up to 21.50, something like that. It really spiked upwards, and everybody expected the great breakout. But then we always said, well, actually, have a look at the opportunity costs, have a look at real rates, how they developed, with what huge amount of headwind that provides to the price of gold. If you would have told me 2 years ago that interest rates would be above 5% in the US, and we're seeing significant disinflation, if you would have told me that the 10 years are trading at, what is it, 4.2, and the 2 years at 4.5%, and the price of gold will be trading above 2,000, I would have said, no way, it's not gonna happen. So from our point of view, is actually the best is yet to come. As soon as the Fed starts lowering rates, although we have to say, with this CPI print and also economic numbers coming in pretty hot. I don't know what the GDP now by the Atlanta Fed now must be like 2.7, 2.9, something like that. So that would say that we're still far away from a recession, but we kind of stick to that recession call, and if you have a look at this development when it comes to last year, the sentiment was, at the beginning of the year, it was hard landing, then it was soft landing, then it was no landing, and now the new term seems to be a no session in a Goldilocks environment. I'm not so sure about that. So how would you see? I mean, I hope we don't agree like 100% on that topic. What's your view on gold in this environment of pretty high opportunity costs, in an environment where the economy is still holding up so well? Do you think that gold is already kind of sniffing out that something's going to happen, and the Fed will, at some point, as they always do, start panicking and lower rates?
Yeah, you had a great chart showing the change of Fed's interest rates, and when they start to cut rates, and you have this appreciation of gold. And I think you're in the money with that, because that's ultimately what probably will happen. The problem here is certainly, I mean, this change of correlations that we're seeing. I was at a dinner recently with a JP Morgan roundtable event, and this guy was pounding the table on Bitcoin, which I have nothing against Bitcoin, by the way, but saying that gold is losing its value and losing its status as a reserve currency. And I've heard this so many times that literally the next day we see gold making new highs in 6 different major currencies. And so, we know the central banks are buying that. You guys covered that very well across, especially the Eastern societies have been big buyers of the metal. And so it's hard to believe that will change, given also the imbalances that we have in the treasury market that we discuss with issuances and inflation and so forth. And what we haven't seen yet is this movement towards hard assets with the inflation problem staying more stubbornly. I have always been of the view now that it's, instead of this interest rates staying higher for longer, it really is inflation staying higher for longer is probably what's yet to be the case. And when we look at how much financial advisors own of gold, there was a survey from Bank of America that was really interesting in that front. front, about 71% of them actually own 0 to 1% allocation towards the metal. And so the 60-40 portfolio allocation, when you think about how expensive they have been over history, it's they're one of the most expensive levels we've seen in ever. And so I think that that's also in line with the fact that most of those institutions are going to have to diversify away from the 40% that has been ultimately all treasuries into some other things like gold. And even if it's 5% allocation, it would be a big change in terms of the drivers for the demand for gold overall. So yeah, I think that's the big story that's likely to come. The other thing that is happening that I find it important is the steepening of the yield curve. The steepening of the yield curve after being deeply inverted, I think. So we created a measurement that looks at the percentage of yield curve inversions in different parts of the credit markets, and especially treasuries. And you can see that we are above the 70% threshold now for about 50 months straight. And that never happened in history, by the way. It's by far the longest period we've seen in terms of percentage of inversions being above the threshold of 70 in history. And again, by far. And usually that 70% is a recessionary threshold. Every time we cross that, a recession follow. And so to me, it's inevitable that we're going to see this steepening of the yield curve here, which a lot of people will see it as a strength of the economy causing that, but it really is probably going to be caused by the reacceleration of inflation. And ultimately, we're probably going to get into a recession. The narrowing of equity markets in terms of leadership is such an important part. The fact that we're seeing small caps still in the bear market, and especially if you look at equal weighted Russell 2000, and clearly we're seeing some big divergences in equity markets overall, from mega caps to small caps. From employment's perspective too, if you look at truckers and industries like that tend to lead the economy, those are also rolling over. And so I'm worried that that profusion of macro indicators that we have that suggest that we're going to see a recession here very soon. And at the same time, we have the speculation environment with multiples being so high. I think it's sort of noise. I'm not. I'd rather not pay attention to those frothy valuations and continue to focus on things that continue to improve as well, fundamentally speaking, and are likely to enter a structural bull market moving forward, which is emerging markets and resource companies overall. So a big answer here, but it's I'm of the view that we were going to see a recession. I don't think that the fact that we haven't seen a recession is it just strengthens the case that we're probably going to see one rather than the other way around. And I would say as well that bull markets don't start with a CAPE ratio of 30 and unemployment being at a full employment as well. So we're likely to see some sort of big deceleration of growth, if not a major contraction. And so I don't think that's much in line. And one last point, if you don't mind, is on the margins that I think will be a big one. Looking at throughout history, when you look at compensations relative to revenues across corporations in the US, companies have never been so profitable in the US like they are currently. And usually throughout history, when we have this very large margins, they tend to actually lead to other decades that the subsequent decade tends to be very weak. In fact, big contractions of margins and big contractions of fundamentals in companies overall. And I think one way that we might find that is through compensation. So as we see this more wealth gap and all those issues that are unfolding today in the economy, now one of the worst wealth gaps we've seen in history today in the US, that will create the demand for folks to actually demand higher wages. And as we see that should squeeze the margins of companies too. I think that's something that not a lot of people are paying attention to. And we certainly are. We're trying to look for companies that have that risk of margins being squeezed by labor costs increasing substantially.
Talking about negative sentiment, perhaps once more, we had an internal meeting, and Ronnie, I think, came up with a comparison of uranium which was a big darling of commodity investors for years, but nothing much happened for years, and situation got worse and worse. And now finally, I think people who have invested and stuck to uranium investments are finally seeing some kind of a payoff. And it's one of the few sectors in the commodity sectors which is currently performing pretty nicely. So is gold, or perhaps even more silver than uranium? And if so, what do you think? Which pockets now are perhaps potentially the cheapest? Where are you looking at when it comes to gold and silver mining?
Well, the overall metals and mining industry is just, to me, is where the real opportunity is. When I became more bullish in commodities, I broke down across all commodities and tried to understand not only from a valuation proposition, but also from growth and what was, how those cycles tend to unfold and so forth. And my understanding is, yes, you want to be long all commodities essentially, and people try to overdo analysis on things, and what I find it interesting is that this reshoring of economies, especially developed economies that we're seeing, this trend is real. And the amount of fiscal stimulus going towards those infrastructure developments is definitely happening. And you can see that from many fronts, is particularly actually from exports of steel producers in outside of the U.S. to the U.S., which is really interesting as well. But it's hard to believe that we're going to see all those trends ongoing, especially the Green Revolution and so forth. But I would say that the revamping of manufacturing is even more important than the Green Revolution itself. Will not drive the size of the market in metals and mining much higher. I made a point recently about how Microsoft alone is twice the size in terms of market cap of the entire energy space. And the energy space today generates twice the size of free cash flow than Microsoft does. If you extrapolate that in the mining space, as you guys have done it too, it is, it's perplexing almost. But to me, it just speaks to the opportunity here. In terms of understanding the micro developments as well, in terms of the metals and mining, I get really bullish on especially precious metals, because I think that's out of favor within the metals and mining industry. I mean, speaking with people that used to be big, proponents of the gold space, have been thrown in the towel and getting into copper and lithium and uranium and so forth, which doesn't mean I'm not bullish in those things, but I don't want to lose focus. I think that the silver chart and the likelihood of an explosive move of silver is higher than anything I can see in the commodity space. The last thing I want is to miss that. So I'm looking for assets that are high quality, that provide that leverage to silver prices as of now. I think it's been the case for me for the last 2 to 3 years. And building a portfolio of those ideas, it's not easy and it takes time. And so, but I think there's a lot more to do in that front. And so I'm extremely bullish you look at the gold to silver ratio at about 87 or so. I mean, when was the last time we've seen those numbers? I mean, those numbers usually come when we are at the very bottom of the market of precious metals. I've never seen a bull market in gold that is not led by silver. And so, I'm really bullish. And I think the big surprise for myself has been the resilience of gold that has not been met by the resilience of the miners. The miners have been destroyed, even with gold prices staying where they are. And some people point to the cost structure of those companies that have been rising relative to gold prices, and that's a fair way to make those assumptions. And then, I've seen somebody saying, well, you don't want to be bullish on gold until you start seeing the gold to oil ratio rise. That is just crap, I have to say. You go back to the early 2000s when we saw the miners have one of the best trends we've seen in history in terms of appreciation. The gold to oil ratio was actually falling during that period, meaning oil was outperforming gold. And that cost structure situation still caused actually gold miners to appreciate significantly. So, there are other factors that matter even more than those things. Oil it's actually an important aspect, and the energy cost is an important aspect for cost structure of the miners, but it's not all you need to look at. The miners are usually really difficult businesses to own ultimately, they're capital bleeders. They misallocate capital majority of times, but there are some decades in history you want to own them. And I firmly believe that those decades are usually inflationary decades because you tend to see hard assets outperform the cost of producing those assets. And so I think we're in another one of those. And for people that are losing their focus and claiming I shouldn't be focused in the miners because they haven't done anything in the last 5 to 10 years, that's the main reason why you should be looking at them, because they're off the radar. Nobody expects them to do well. And clearly there's just a final point. I had the fortune to speak with Sam Zell before he died. And I had a call with him to basically pitch our funds to him. And I've been a huge fan of Sam Zell. I mean, I've read everything I could get my hands on from him. I think the guy was one of the smartest investors we've had. And one of the biggest things that I heard was at the end of that meeting, he told us, this is incredibly interesting. And I think you guys are onto something. And you guys are probably a little early, but I think you guys are going to make a killing. And I'm not saying this to talk about my funds. You guys are launching a fund too. I'm just talking about the overall space that is from a guy who is as contrarian as it was Sam Zell. To me, it was just fascinating. And unfortunately he passed away, but it's those words were wise words to me. And I'm taking that at heart. And I still think that this is a generational wealth opportunity to create multiples of your capital if you invest wisely in the mining space.
Obviously, we agree, and I think we've been talking about Sam Zell, we've been talking about Druckenmiller, but it's also Buffett at Berkshire Hathaway. He's beginning to sell down his Apple stake, and I think what he bought actually recently is Occidental Petroleum and Chevron. So he's clearly moving into the commodity space. While also interesting, probably that Jeff Bezos sold $4 billion worth of Amazon stocks, and there are probably only like two moments when you sell $4 billion of stock in 4 days, when you have to do it and when you're not stupid to do. So I don't think that he has to sell it now. So he probably knows quite well. But coming back to the miners, Tavi, I mean, we both know that it's a incredibly complex business, and basically everything that can go wrong will go wrong. And we've got management risk, and we both know that we tend to see not the biggest the best management teams in the mining space quite often. You've got political risk, lots of bad news coming out of Panama, out of Mexico, also out of Canada. Then you've got geological risk. Obviously, we've seen it in Turkey quite recently with this tragedy. Then you've got interest rate risks, and I think it's interesting that actually those mining companies now, really, especially the juniors and the developers, they're really feeling this deflationary development, this lack of capital, this very high cost of capital. That's really, I had a couple of meetings with really good folks in this industry with, I think, decent projects that say, well, we don't find anyone who wants to put in money. So it's really staggering what we're seeing in this space. And then obviously we also have the price risk coming from the price of gold that you cannot control. You've got market risks from the equity side, and it seems that all those negative things are now being priced in the mining space, and usually many things should turn around and turn for the better, hopefully. So I think we've got, when it comes to mining in general, at the moment we've got quite similar views. I think we're both, all three of us, are pretty bullish. But when it comes to the setup of our funds, we've got different views. So Mark, perhaps you can briefly describe what we're trying to achieve with the new fund.
Happy to do so. Well, yeah, I think we are having a really innovative approach in regard to the fact that we are of the opinion that this is a very top-down asset class which we're dealing with, gold mining equities. Perhaps one of the most top-down asset classes which one can get. Obviously, on the bottom-up sector, a lot of inputs you just named, most of them, Ronnie, come to play. But from the top-down side, price of gold, we write the In Gold We Trust report, hundreds of pages, and it's just such a complex topic which we're dealing with. So it's very much a top-down approach which we are also taking in this fund. And coming from this, we actually wanted to create an approach which captures the huge upside which clearly exists, but also deals with the downside risk more actively. Because we all know that this is a very risky asset class, and the drawdowns can be very, very brutal, and a purely relative return approach didn't feel very I think sensible to us. So that's why we put a lot of thought process into this approach, and we actually basically have three pillars of this approach. Number one is our strategic portfolio composition. We don't only go long stocks, we also look at bonds, and we can also do some private placements. We think there are some quite interesting opportunities on the bond side, at least if you don't want to invest all your capital into equities, if you want to play it safely for top-down reasons, perhaps. We then have obviously our market timing indicator, which gives us the top-down input. How much capital do we want to allocate towards more riskier subsectors? But the third most important, still important pillar is then also a bottom-up analysis. So obviously one has to look at the names very diligently, and that's especially where Ronnie comes in, since he's in the space he's been in the space for a very long time. But this is basically our very active approach which we are taking here. And we also want to have a little bit, perhaps more a conservative approach. Obviously, if we're not fully invested all the time, we will not have probably the complete upside. But we want to capture most of the upside, and obviously want to manage the downside very actively, and want to provide hopefully superior risk adjusted returns with this strategy. So this is what we're aiming to do, and be very I think we think we have a good starting point now, and it's developing pretty well so far.
So it is a little bit of a, in sports terms, it would be offense wins games, but defense wins championships. So we really try to avoid the major drawdowns that we're seeing in this space. Now, Tavi, many people know you and Crescat, especially for the the junior mining space, but actually you're not only active in the junior mining space. You're also I think you've been moving more into the commodity space in general. You've got a macro fund, I think, that Kevin manages, and didn't you also announce something in the pharmaceutical or biotech space recently? So tell us a little bit more of actually how you distill and use all the thoughts, the macro thoughts that we just talked about in the last hour, how you structure your different funds.
Well, the Global Macro Fund is where we try to approach things with themes, macro themes that we believe will play out. The biotech one was one of the themes that over the last call it 2 to 3 years, we've actually hired a scientist that has been advising us for a while now, and it's been just to understand about the industry overall and opportunities. They're similar in the sense, but the way we're playing that in the biotech versus the mining space is quite different. We're looking for companies that have already a very strong potential, are in progress of their phases to approve a drug and very close to it, and at the same time, not only knowing the economics of the potential of that drug itself being sold in the market, but also understanding their balance sheets. And we look for very safe balance sheets that we can play those. And I got to say, that's probably our best performing theme in the portfolio, but I also think it's on the back of the AI trend and other things that have been causing that too. The way we structure the portfolio in the global macro is thinking about the big themes. And some of them are short themes, others are very bullish themes. The bullish themes are usually resource driven as of today. So we have big views in the energy space. It's hard not to be bullish on energy, given that you have strategic petroleum reserves now starting to rise. You have oil and gas rigs is starting to contract. The fact that you have 30% of the economy now is higher than about 30% higher than it was pre-COVID. And if you look at the domestic production, is about the same level. And given how those companies are so cheap, fundamentally speaking, and so also have very large dividends and buyback yields, if you look at in that front. And so we've been buying energy companies for a while too. And I would say that this is probably one of the most bullish environments I've seen for energy today that I've seen in the last 2 to 3 years. And so I think that's I think that says a lot about our positioning. And we've been shifting also towards emerging markets more and more, and Brazil has been a place that we've been hiding, but also South America in general. I mean, the fact that you can buy mining companies in South America today, you're talking about a little bit about the mining space. There's different things that prioritize markets in terms of the mining industry. Mm-hmm. And today I would say that jurisdiction has been a big thing, right? Jurisdiction, risk, companies that have better jurisdictions have been, receive a premium in terms of their valuations relative to others. And I think what's going to change in the near future, and why we like South America so much, is how much quicker you are able to get a project into production. And so that easy access to production in places like South America, given the approval rates and so forth, that you can speed up that process significantly depending on those areas, which sounds crazy, but it's true. Is probably going to be driving the multiples back to jurisdictions that are less attractive, but because they're able to get into production much quicker, you may see that premium dissipate and actually close the gap of valuations between good and bad perceived jurisdictions in general. So that's one thing to point out as well. In terms of the short side, I mean, we have the steepening of the yield curve trade, which is becoming bigger and bigger. And I would say that every time we see more of that trade actually inverting further, we've been trying to increase that position here. I have a very strong view about that trade, and so we've been trying to allocate that properly and have a big enough of a position that would help us if we're right about it, and obviously trying to avoid the risk as well. But that's I would say that's an interesting way to play the recession idea. And the mega caps that we have shorts, we throughput options in different of those names, and I think that's majority of them are driven by our models that we look fundamentally to find those opportunities. But I would say that majority of not all of the mega caps are as expensive as you would think, but some of them are starting to show very strong deceleration of growth, and at the same time are very clear deceleration of growth, and at the same time multiples are still trading as if those companies are growing at double digits. And so those things are going to have to, I think, we're probably going to have a reckoning environment for those things to go back to more normal levels. And as we see that, probably will drive the compression of multiples that is driven by the depreciation of price of those companies. And so that's one other section of the portfolio. But those are the things we've been thinking about. And I would say that the mining industry is interesting to me just because of how much you can add in terms of the activism to add value to those companies. I think of them personally and through the portfolio as all basically call options. They're all junior companies, very small businesses, and they're almost like call options that we have, but they don't have an expiration. We do know that they're going to be diluting every 2 quarters because they don't make any money. And so that's why I see them as a call option, because you got to get it right if eventually, otherwise you're going to lose value just on the dilution. But the whole point here is that you can increase, instead of buying a call option in SPY or any ETF or so forth, or any other asset, the difference here, you can improve your odds through activism. And if you find a person like Quinton Henney, who has been helping us advising those companies to improve their odds to find those discoveries, that's the interesting portion to me. And we've been able to find a discovery every year, basically, starting with Newfound Gold in 2020, and then Snowline Gold more recently, and then we had Hercules, and then now San Cristobal. And so all those things, they come to fruition because of an expert helping us to deploy money more intelligently than I think those companies would do on their own. And so it's all about finding the right people to work with, which is not easy, as you know very well. This industry is so distressed that it's actually reflected on the leadership of those companies. And so finding a good CEO is as rare as finding gold. And so it's been it's not easy. But again, if you're able to work with some of those companies that have great assets, and you're able to unlock the value through finding those major discoveries, that's where you really can create value here. So it's a little bit different than what you guys are doing, obviously, but I wouldn't be able to do that if it wasn't for Quinton. And so I think finding those guys that are able to make those discoveries is absolutely critical for this. And if there was ever a time to do that, I think that time is now, because production is down. The majors are facing a supply cliff issue, the deterioration of their reserves. The average grade has been declining. They're not spending enough money. In fact, CapEx is actually declining in the quarter-over-quarter basis now, which is really interesting. And so, they're being way too conservative. And so it's time to be investing in exploration. And my final point is the M&A opportunity. There's definitely an M&A cycle opportunity that could change the whole industry. And we're starting to see that engagement of majors with the small companies now.
Well, Tavi, so many great things that you said in the last couple of minutes. I mean, I think sentiment-wise, I should print and frame that email. John Hathaway and Mark and I, we really know him for ages, and he has been some sort of a mentor, and we developed really a great friendship over the last couple of years. I once asked him, John, why did you set up the Tocqueville Gold Fund at the end of the 1990s? And he said, well, actually, we had a partners meeting, and we said, okay, we have to come up with a new fund. And he said, gold mining. And everybody started laughing because everybody thought it's a joke, which was for him a really good sign, that it's probably as contrarian as it can get. So he emailed me this week and said, I hope your timing turns out to be as good as our timing 25 years ago. And the idea is as contrarian today as it was then. We started with 10 million and grew it to over 3 billion at the peak, probably a month or two before the turning point, but that is the time to start. We will be cheering you all the best, John. So I think the same goes for you. I think we're definitely in the same camp. Tavi, as a little gift to our viewers, to our followers, we asked on Twitter, or now X, about specific things that we should ask you about, and there were some names coming up, some company names. If you can talk about it, that would be great. If you're not, due to compliance or whatever, of course that's no problem at all. And then of course everybody wants to know what's gonna be the next Hercules or the next Snowline. So can you?
Yeah, I can elaborate on some of those names if you don't mind. Yeah. Look, I think there's a few buckets of opportunities. There are companies that have drilled their properties for the last 2 to 3 years and just haven't had the luck that, a Snowline, Newfound Gold, and even Hercules had over the last years. And does that mean they don't have anything? No, there's definitely very strong potential that they can find something still, but the prices are not reflecting those probabilities. And so I would say that there are some old names in our portfolio that used to be really interesting that are not attractive anymore because of failure in terms of finding enough or great intercepts. As we all know, either you have an exceptional intercept in the exploration industry or part of the industry, or your stock price will get demolished. And so we've had lots of those, and that unfortunately didn't pan out to be the Snowlines and Hercules of the world. And I would say that some of them, SK Mining still comes to mind. I can't imagine that such a real estate that those guys have in terms of property won't turn out to be something interesting. And so ultimately there's those are very contrarian views even inside of the industry, to be quite honest, because they're kind of old names in our portfolio that just haven't live up to the expectation. And I would say that valuations have certainly deflated and now look more attractive. And you have Eloros of the world that as well look the same way, that didn't, they still have some great assets, but just the price of those companies don't reflect that. Now, on the side of things that they haven't really found anything yet, and they're still with more excitement on the back, Altamira is the first thing that comes to mind. Those guys have great assets in Brazil, in Pará. They are certainly a company that we work very closely with Michael Bennett, the CEO, one of the good CEOs out there to work with. A very open-minded guy that helps us to know that we are able to really have an activist role with the company. And it's a company that it continues to develop well their resources, and with a very high likelihood of having another Snowline type of discovery with very consistent grades, and they're drilling now deeper in that zone, and most likely will probably be another one that could surprise a lot of people to the upside. The second one that comes to mind as well that I think is really attractive is Barksdale. They have the best part of the Taylor deposit. They de-risked this story substantially recently. I know a lot of people usually people get more bearish when prices decline. I'm the other way around. If it gets cheaper, I get more greedy, I guess. And I think that's the way people should behave, but that's not how the retail world of junior mining works. And people just get spooked by things. And look, these businesses are very difficult to run, but if that's a great asset that has a lot of potential to find the best part of the Taylor deposit, if that's the case, that's not worth what it is worth right now in the markets. Other things like Fathom Nickel look really attractive, but ultimately I would say that some of the best opportunities we're seeing is in the private markets. A lot of the major companies, fortunately or unfortunately, are looking to sell some of their assets, and as they do that, some of those assets have still 5 to 7 years of mine life, where you can purchase those assets potentially and create another roll-up strategy to buy a bunch of distress opportunities for the next 5 to 7 years, and then on the back of that actually reestablish a better production profile in a longer stance of those mine lives, and improving that and finding more ore. And obviously all those are unique opportunities. They're all different in many ways, but the San Cristobal idea came from something like that. I mean, obviously the fact that the mine life was being reduced substantially, drove the need for the prior owner to want to sell that, and it was one of the largest silver and zinc mines in the world. And now for us, the goal was then, well, let's use that cash flow to redeploy that and find more opportunities and more ore. And we've been able to do that in a way that I think it might be one of the best discoveries we've seen in history of silver. And so, that to me is where the real opportunity perhaps lies ahead, is finding those assets that produce cash flow that you can redeploy into exploration, and hopefully improve the size of your reserves and improving the profile of the mine in terms of mine life. And so there are some great opportunities in that front, perhaps even more than the public markets today. And that's where I'm spending a lot of my time, actually, looking for those opportunities today. And so, and finding strategic investors to help you purchase those assets and so forth. And there's a lot of these strategic ways to do those acquisitions that could be potentially done just like San Cristobal, but in different parts of the world. So not specifically answering the question with one or two companies, but although I said a few, but that's, those definitely are ideas that come to mind as potential ways of making a lot of money in this industry. But yeah.
Thanks, Tavi. I mean, I'm also on the board of Tudor Gold, and they just put out an updated mineral resource with 27 million ounces and a higher grade of 120, and the stock is only slightly up. So we can really tell, in a good market, the stock would probably be up, I don't know, 20-30%, but it is what it is, trading at 189 million. That's pretty obvious that it's a bear market. But that's, as I think Jim Grant once said, that the only permanent truth in finance is that people will get bullish at the top and bearish at the bottom, and it's it's always the same.
I was going to say another interesting idea that we've been very focused on has been Kuya silver. Yeah. It's just so hard to find good assets in silver, and just to share that one quickly, they have a development more asset in Peru, but the idea really isn't that as much as their other project in Ontario, which is likely one of the best discoveries as well that we've seen in a long time in terms of the level of quality of those intercepts that they did in their first program. It already is very intriguing, to say the least, and that's something that we remain very bullish on right now, that could potentially be worth a lot more than what it is today. And there are other assets like private companies like Blackjack Silver. They're private companies now actually raising money. Those that we're probably going to put into the public markets at the right time, and that there probably could be one of the best silver companies in North America, especially given the amount of reserves and the quality of those reserves. And so there are no shortage of ideas out there. It's just people, as you said very well, are very, very bearish and negative and are throwing the towel into this whole industry. And, those are usually the times you want to be picking up those shares at really cheap prices.
It sounds so easy, but it's pretty hard.
Oh my gosh. It's a few gray hairs you can see here, but it's
at least you still have hair.
I don't know. It's going deep here, Ronnie.
Yeah, but I don't know how Mark does it, but good hair hasn't been the biggest strength of mine for the last couple of decades anyways. But
you should call the hair indicator for the mining industry would be a good one. You guys should come up with that. Mark,
I think we can wrap up.
Yes,
or do you have any other question?
Big thank you from my side, Tavi. I think this was very informative, and thanks for taking the time. We appreciate that a lot. All the best for your strategies and investments.
Tavi, obrigado. Thank you very much. Keep up doing such a great job. Say hello to Kevin and to Quinton, of course. And we'll be in touch. And again, thank you very, very much for taking the time. Take care, my friend.
Thanks, guys. Appreciate it, and good luck with your funds. I'm very happy we're seeing more of an activist role in the space, and big proponent of folks like you guys, entering more and more of the space. I know you guys have been in the space for a long time, but it's nice to see that you guys are raising money to deploy into this industry. I think you guys are going to do very well. So congrats.
Appreciate it.
Good luck.
Yeah. Thank you very much, Tavi. Take care, my friend. Thank you. Bye-bye. Thanks.